Peter Rose, Longwood Currency Trading. Good morning. This is a sad tale of a bad Forex trade that worked out. And just to top it all off, this morning, which is early in March of 2020, well, mid-March of 2021, it was, I think, something like 8 degrees or something. It's 8 degrees right now in the morning. We got up this morning and the heat was off. Yeah, this is not good in New England. I went down, press the button, and the boiler comes back on, and then it's not working right. So we're having a cup of coffee and waiting for the service technician to come and see what's wrong with the furnace. Hopefully that's not bad. But I got a story to tell you about a trade that I took that it was a bad trade, but it worked out. And that's not good. So here I am in the library, wondering how I'm going to present this in a reasonable order for you, because the title of the video is a bad Forex trade that worked out. What's a bad trade? Well. You don't know if it's a bad trade until after the fact, right? Most of the time. But a lot of the time, you make a trade and you go, I don't know whether that was such a good idea or not. Now, maybe you misjudged your structure or whatever indicator process it is that you determine that you're going to enter a trade and that's weak. Or maybe you go in a little heavier than the situation warranted it or whatever, so that you can kind of preface all that with a sense that it isn't the best of ideas to go by, and I'm unsure as to if I didn't have a collection of those reasons for saying as I as I went into the thing and it started to go against me. That probably I should get out. My rules said I should have got out. I'd had a couple of pretty successful trades before that, and sometimes, many times, that initial success of the day or whatever makes you think, well, I can do it again. You're better off just not doing it. I did a trade this morning, for example. I had a good feeling about it. Structure was right. All the things that I use to indicate a trade will be good. I went in very light to start. It confirmed itself. I tripled that position. It continued to go against me. I doubled that position, rode that through, and in 15 minutes I had made I don't know, $600 or something like that. So you have a sense for these things when they are moving in your favor, and you extend that winniness. You load in as you become successful at it. You could stage out if you go in heavy, or you stage in so that you come out heavy. It's one of the two. But whether you're doing it correctly or not. So what happened was, in the trade that I'm talking about that was bad, was I went in, things looked good, I put my full position on, things looked good for a while, then they turned around against me, and then they went for me, and then they turned around against me, and then they went against me. I made a decision to look at that situation a little differently than I did when I entered the trade, and convinced myself that I was basically reacting, the price was reacting to a rather large gap between the moving averages and the price action. What you would call a regression to the mean, a potential regression to the mean. And so I thought, well, because I'm a day trader. I'm on a short time frame, so the regression to that mean was a short distance. It was quite a bit of money, but it was a short distance, and so I thought, well, I'll weather this out and I'll stay with it. So the problem when you think about things like this is one of Jesse Livermore's famous statements that he made when price was going against him. Well, why don't you get out? Why don't you get out? And he'd say, well, I'd lose my position. And what he meant by that was, if the price is going against you and you get out, then you've lost that money. So even if the position turns around and moves in your favor, you have to make that money back before you can go on and earn money. Whereas if you didn't get out of the position, you haven't really lost anything until you close that position, and so you're not fighting it. It's just going in your favor, and then you're okay. And so if you're looking at a situation like I was in, you would say, I don't want to lose my position, because at that point I had my basically my full position on at the time. Well, speaking of bad positions, the klaxon, submarine dive klaxon that you heard in the background, that ooga ooga, that was my wife calling. She'd been out walking the dog, and man, it's really cold out. It's like 10 degrees out, the wind's blowing 35 miles an hour, and it's like below zero. And she calls and says, she's walking the dog in the woods, and she calls and says, a bunch of turkeys were walking by, and the bow dog took off after the turkeys, and she can't get the bow dog back. So I have to get in the car and drive down to hunt for the bow dog. And not only that, I have to get some warm clothes on, get my boots on, and I have to leave the basement door open for the service technicians who are supposed to show up pretty soon to see why the furnace went off last night. And my wife asked a doctor's appointment a couple of towns over. So, you know, it couldn't get any. I mean, you know, we should have topped the day off with me losing the trade today instead of making some money. But, you know, fortunately, because I'm a day trader, I can get in and get out. I looked at my position, I got in, and in 15 minutes I was out. I made $600 and I'm out for the day. I'm fucking done. And so I can go on and do these videos, and I'm talking about this trade that I had entered before, where we had this regression to the mean event taking place. And so I thought, well, I'll just stick with it. I won't lose my position, as Livermore was saying. By the way, I've swung out of the bright sun because it was too bright. I still have my coffee though. And you're, as prices, if you're looking at a regression to the mean trade, initiating that trade, there's a way that you look at it, but you have to jump on that pretty quickly, because generally the distances to that you're regressing aren't very great. And I mean, you know, they could be 15, 20 pips, which is enough to make a legit trade. But it takes you a little bit longer to figure out that you're in a regress mode. Most of the time, they don't go all the way and hit the period moving average line that you think they could go close to it. Sometimes they'll go over it. And so you don't have very much room to play with. So that's why if you're in a trade and it starts to go against you, you don't know whether it's a regression movement or whether it's a regression to a higher time frame moving average. You just don't want to play those unless you're up on a higher time frame. And then playing a regression to the mean works. But when you're day trading, don't do it on the lower time frames. So in any event, I'm watching this happen, and because of my trade was in the direction of the main directional bias that the 4-hour chart was on. It was consistent with the 15-minute chart. I was in good shape. So I just thought this would be a short regression to that mean and a carry on for this particular trend that I had grabbed onto it. And so as it went on beyond, I thought, well, you know, I'll just, it's going to come back. It's going to come back. Holy crap, how many times have I said that? And instead of getting out, I held on to it. And that was where the bad trade occurred. In fact, there were 4 errors that I made in this trade. I stupidly allowed myself to get in to the trade to start with, and I shouldn't have, because it wasn't an optimum entry point. I was just kind of riding on the coattails of a trending market. Number 2 is that I stayed with that trade in total hope mode after it went beyond this regression to the mean thing, and that wasn't going to work. And the third thing is I used a method of working out a trade that's gone against you that I had talked about in a previous video that I had made called 2 ways to manage a losing Forex trade. The first way was just to get out of the trade, and the other was so let's say I'm in a short trade, which is the case that this one, and it goes against me on the long side, and I hold it way too long. Well, when it turns around and starts going in your direction, and you look at that and say, well, I would take that trade again. If I wasn't in a trade, I would take this trade again as moving in the direction of the bias. Then you would get in. Some would call that averaging into a trade, averaging down. But that's usually done when it's continuing to move against you, and you're saying, well, it's not going to go any further. I'm gonna add another lot or whatever to the trade. In this case, it's moving in your direction. It's just you're underwater on your original position and you're adding to it. It's the lesser of the 2 evils, but it's still averaging down. And if you get it wrong, it could bury you. And I don't see, beginner. If you don't have 4 or 5 years of trading, I wouldn't even think about doing that, because when you get it wrong, it's really, really bad. If you have great risk control and you do that, but you have a stop set, then the positions that you're getting into later lose you less money than the original one, and so you have to evaluate your amount of risk that you're taking if it goes to your final panic stop point, as opposed to where you're really trying to get to with your profit. And still, if you lose, you're going to lose a lot of money. So generally speaking, the stuff works when you're playing out on a higher time frame, not necessarily the daily or the hourly, but or the 4-hour, but maybe if you're out on the hour or 4-hour, yeah, you can make those decisions. The problem with being down on the lower time frames is that if you're not really, really disciplined and with the thing and get in when you're absolutely sure, the losses become really bad. And I mentioned that in that video, 2 ways to manage a losing trade, that this is really a catastrophic move to take to work your way out of a bad trade, where the real way to get out of it is just to exit out. But I used that method in this trade to get out, and it moved against me again. In exiting the trade, after that failed, again you balance. Well, I would have lost my position when you're certain that the trade is if you understand trading it isn't us, the retail traders, that are driving price in a particular direction. The large institutions are simply transacting business to fulfill client orders, and it's only when they're done with their business and they're running the price up and running it down and running the price up and running it down, and if you can establish that it's the institutions that are running the price against you, when they get done and there's no more, they're not manipulating the market anymore, and the market starts to go where it normally should have gone, the move goes very, very quickly. And I wasn't delusional in my thinking that the market would turn around. And even though I had doubled up on my position and was losing thousands and thousands of dollars, a lot of thousands of dollars, I made the decision that I would not exit the trade, even though it was continuing to move in my direction in a very dramatic manner, but that this was an institutional move, and that the long-term trend would be realized at some point. And I didn't look up to those higher time frames to see what moving average could potentially the thing bounce off of on a big regression. I was banking on the fact that I got caught in an order flow situation and that eventually things would resolve itself. And I have to tell you, if I would have exited, I mean, the pain was brutal. I was the equivalent of 20% down. And at that point, your thinking becomes, well, if I go to 25% down, it means I got to make about 35% back, 40% back, in order just to get even, maybe 50%. I don't know what the exact thing is. So that could be a whole year's work to work your way back, break even. But if the thing turns around and goes in my direction, as it should, then I should be okay. And so I stayed with the position. I just walked away from it and did a carry trade. Actually did a couple of nights of carry trades on it, and it was 20% against me, and I was thinking about pulling the trigger, and I'm down on the real short time frames, and I'm looking at price action, and I thought, no, this is going to turn around. It has to have advanced. To make a long story short, price did turn around, and in about an hour, it retraced. Let me see. Let me pause this for a second. I got a call coming in. Yeah, I had to think how many. I was about 130 pips out, and that's just stupid for a day trader to be 130 pips out. From a long-term standpoint, that's nothing. The ATR on the currency pair is over 100 pips a day on a daily rate. So yeah, I mean you could suck that out very quickly. And in fact, that's what happened. Is even though I was 130 pips out, the thing turned around, and in about I gotta say about 2 hours, 2 or 3 hours. It went 145 pips in my favor, and I ended up closing the trade for about a $700 gain, so about 10% of what I was down. But the point is, in managing the loss the way that I did by increasing my lot size as the price had originally come down to where I thought, well, this is confirming that it is going to move down in my direction, and I doubled up my position. I probably could have been a little bit more conservative and just double, put one lot in, and then if it would have gone a little bit further, I put another one in, and then if it went against me, I wouldn't have been so heavily negative. Not that it would have done any good, because it never had a retraction. In other words, it came down and then it started to go back up, and it never did a downward thing again until the price just, I mean, when the institution was done with doing whatever it was done, and it was like the toilet flush, and the price just went down. And because I had averaged in way up there, the price only had to move slightly below where that average was in order for, because I had such a large position on, for me to make $700. And so, yeah, I could have stayed with the trade, and maybe I would have made $6,000. It's immaterial. You don't make a maneuver like that to run with the trade after you've got at least break even, or you get out of the trade with a profit. And so I got out of the trade with 10% what my losses had been on very few pips, because I had a heavy position. So it didn't, and that's why you put the heavy position on, because it brings that average up so that you don't have to penetrate down very far, or to get to break even and to make a lot of money. And because you have quite a few lots on, every pip is worth a lot of money. So it worked. The process worked, and that was unfortunate. It was unfortunate that I got into it, and it's unfortunate that it worked, because now I'm going to think, well, I've done this before, and a couple of times it hasn't worked and it's wiped me out, and a couple of times it has worked. This is the third time that I've been able to work my way out. But the 2 times that I went before when it didn't work out, one was when I had my original large account, and that loss was, that one trade cost me 10 grand. And actually it brought me to a margin, and I just closed it out. Margin call. So when it doesn't work, it really, really doesn't work. It isn't something that you want to do unless you're really, really skillful. And I'm not proposing here that I'm skillful. I was able to, based on my experience, to see the price action at this particular time be a contrived action by the big institutions doing their order thing, and eventually they had accumulated. You could see them accumulating and accumulating because it was going very slowly up. It wasn't spiking up. It was very slowly. So that, and it was counter trend. So you knew that the institutions were buying and buying and buying and buying, and getting all the other people to come in and buy, so that when they got around to selling, boom, you knew it was just going to go. You knew it would. But only if you had a tremendous amount of experience, so that you could recognize, a pattern like that. And I'm not an expert in that. I got lucky. And that's what's unfortunate about the trade working out, is I'm not bragging about that, nor am I bragging about at the beginning of, I don't know, I did a video a while back where I made 2.5% one day and 2% the next day, and 4.5%, and that was, I wasn't talking about any skill. I was in the right place at the right time. I did the right things, and I made the money. And then I said, I could have some severe losses to follow that. And in fact, I did. I lost that money. I had a couple of terrible turndowns, and one of them was because I was trying to work my way out of a freaking trade. And so, the account is, for the year, is down a little bit in negative, where I should be, the amount that I'm down right now is what I should be up. So, and it's down because of that there was that one trade this year that took a large percentage. I think it was an 8 or 10% hit because that didn't work. The other time that I used it to work my way out, and this time that I used to work my way out as a percentage, didn't even make up that other loss that I had. That's why I'm still sitting here. So those when you make a big mistake, it doesn't make any difference whether you're a long-term trader or whether you're a day trader. You know, don't point your finger at me and say, fucking day trader don't work because you just make a little bit of money, and then when you lose a lot of money. That's generally not the case. That's generally not true. Yeah, that was a phone call from the furnace guys wondering if I still wanted them to come over. Yes, I want you to come over. The fucking boiler shut down. And it's on now, and the house is warm. But I want you to come over and find out why the boiler shut down. Please, come over. You can't do bizarre stuff that theoretically will work a percentage of the time, because the time between when you would do something like that, the number of times you would do that in your trading career, you don't have the law of large numbers to work in your favor. That's why as a day trader, you know, people are I mean, sometimes I make one trade a day as a day trader, or 2 trades a day. I try to keep it at a couple of trades and just make my money and close out for the day. I don't want to be sitting in front of the fucking screen all day. But sometimes I'll make 20 or 30 trades. And I feel safer when I'm making more trades because I know I've got an edge at the larger number of trades. I've got a pretty good win-to-loss ratio. And so if I am just making 2 or 3 trades a day, then one of those or 2 of those or 4 of those are going to be losers. That's why I keep my loss level, my stop level small, because if I hit those 6 trades in a row that are bad, even if I had a breather stop, if I hit that 6 times in a row, that's not going to make up for, and I'm not scalping. I'm not trading for 3 or 4 or 5 pips. You're trying to shoot for 10 or 20 pips a day on your trading. In those 1 or 2 trades, you try to get 10, 20 pips. But as a day trader, if I'm going in a trade and the trade goes up 4 or 5 or 8 pips in my favor and then starts to head south and it looks like it's going to go back to my take point, I'll take 3 pips because I can get back in. And so you need that 10 or so trades a day to pick up 2, 3, 5 pips to add up to the 15 pips a day or 10 pips a day that you need. Because I'm not good enough on a daily basis just to come in and make 1 trade and get 15 or 20 pips without doing a carry. And I'm not sure many people are, because you have to sit in front of the screen for a long time in order to do that. So if you've got a lot of patience and a lot of time, you can do that, and that's the preferred method. But if you don't have a lot of patience like I do, or you don't have a lot of time, I've got plenty of time because I'm retired, but I don't have a lot of patience. And that's my personality, and I'm not going to change that. So I have to trade according to that. So if I'm going to make some money, I want to make it very quickly. If I'm going to lose money, I want to lose it very quickly and be done for the day. Or I want to trade many times during that day, so that I'm taking a law of large numbers and getting that probability out of those number of trades. So over, you do 100 trades and you say, well, I've got a 55% win-loss, or I've got a 60% win-loss, and then you look at the
amount of money that you lose when you lose versus what you win when you win, and that gives you a number. Between the win-loss and the win-loss ratio, and the amount that you win when you win and the amount that you lose when you lose gives you a number, and that number is your edge that defines your edge. And as long as you have an edge, as long as you trade over a long enough period of time, you'll make money. And this is something that you're not going, if you're going to dispute that, go stick your head in the can, because I'm a physicist and a mathematician and I get this stuff. And it's confirmed by Tom Sosnoff he's in Tasty Trade now, and he says, and lives his life according to trade small, trade a lot. Because he's working on the law of large numbers. He'll do 40 trades a day, 5 days a week, 200 trades a week. What is that? 2 times 4, 800 trades. He's going to do something like, I don't know, it's a tremendous number of trades that he said he did a year, 40,000 or something like that, trades a year. But he knows what his numbers are because he trades a lot, and he has his edge, and he just does a mechanical system. Boom. And that's the only way you can trade. Jim Simmons knows about that. The mathematician. He's probably one of the preeminent traders that there's ever been. Jesse Livermore started out that way. There's two schools of thought here. You can trade for 3 or 4 years. As a long-term trader, you might make a couple of trades a month or something like that, or a couple of trades a week. Let's say you make a couple of trades a week, you make 100 trades a year. That's enough to establish a basic win-to-loss ratio and all that other sort of stuff. But it'll take you a year. Now, as a day trader, you can do 100 trades in a couple of weeks. So, or less. The point is that once you establish what your edge is and you have good trading habits, then you just stick with that system, and in the long run, you end up making money. Now, a lot of the long-term traders say that only 3 or 4% of their trades make up 80% of their wins. And so that's true. The big wins, the 10 bangers or the 20 bangers that you may get, may only be 3 or 4% of your trades. So if you're trading it in a day trading standpoint, short-term trading, you'll hit those numbers sooner because you're trading more. If you don't know how to trade and you trade a lot, you're going to lose a lot of money very quickly. I lost $40,000 in, it took me 8 or 10 months to go through the whole thing, but I lost probably 70, 80, 90% of that money very, very quickly, 3 or 4 months. So it works both ways. If you know what you're doing, a few trades will make you a lot of money. If you don't know what you're doing, you won't make a lot of money on the few trades that you do make a lot of money, the 6 winners in a row. But when you lose, you're going to go to the wood. So again, that's my caution, is not to use these exotic methodologies for trading that an experienced user would use, because if you don't have the conviction of a win-loss ratio and an edge, you really don't know what that is, then you're going to doubt yourself and you're going to change that system. And so when I was involved in this current trade, I got lucky, and I would never teach somebody how to do this, because, and I would not, I will after the experience here, I would say that I got lucky because all the pieces fit together for me. I saw that the institutions were running the price up, and it wasn't going to be sustainable. There wasn't any pin bars or anything like that at all. It was just a long, against the trend, small incremental movements. That is the mark of an institution gradually building inventory, and once they have it all, then they're going to unload it, and you just have to be in the right place at the right time, and away it goes. If I would have been riding that trade upward the way that I would normally trade or counter trend to it, because you trade in the direction the price is moving, not what you think it's going to do, I would have made quite a bit of money on the way up. And then when I saw the break coming, load in at that point, I'd have made 20% on my bank in a couple hours. So because I worked my way out and I made $700 is not a triumph, because that was just a small percentage of my bank. By doing that, by not getting out of that trade when I should have, and that would have prevented me from doubling up on the position, so I was really screwed. And so settling for a small percentage gain after all that work, and it could have very well gone against me, and I could have lost the 20% on my account. I missed out on the opportunity to make a safe 20% on my account. That's what happened. So if you're just getting into this stuff early, you won't recognize all these things and be able to do them. You just want to be able to trade and be successful with it. If you've been trading for a long time, you've tried a lot of different things, and you're trying to figure out what works, find somebody that can help you. And you, if you're a beginner, find somebody that can help you. And listen, don't take a course or take private mentoring classes from somebody if you're not going to fucking do what the course tells you to do or what the people tell you to do. I mean, there's a lot of shitty courses out there, and a lot of people that give you stupid advice because they don't fucking trade. They write courses. If you just look at the thing and go, oh yeah, I understand what you're saying, but I'm going to do this, you're wasting your fucking money. Save your money that you would spend on the courses so that you can lose that in trading, so that you can learn. Because the only way you're going to learn is by losing if you're going to do that. You have to find resources that are valid. Not these guys driving around in their fucking Lamborghinis and flashing their watches at you and all the success and shit that they've had. Maybe they were successful in trading, but you can make a lot of money selling courses, and you're selling seminars and all that other kind of stuff. You can make 3, 4, 5 times in an educational environment what you make from your trading. And the more money that you make doing that, the more time you spend looking for office space and hiring people and working on your website and all that stuff, your trading skills go down. So what are you going to teach then? You teach shit. So you have to make up your mind, as a retail trader as I am, well, what do you want to do? Do you want to make a lot of money from trading, or do you want to just fart around? You're not going to make a lot of money from a small amount of money, but you can make a lot of money if you have a lot of money. But the only way you're going to have a lot of money is don't lose the money that you have, and save a lot of money from your job or whatever it is that you can scrape together, so that you can put that money into your account to make it a big account. So that when an opportunity comes up, for example, in this particular situation that I was in, let's take out the miraculous Hail Mary pass that I did, and just say that I was tracking the price as it was going up, okay, and doing it correctly. So I put in my money in my position, and I would be fully loaded pretty far along on that. So let's say you had a $3,000 account. You put 3 minis in it, and the price is moving up, and you're saying, geez, it's still going to move up. Well, you got 3 minis, and they're going to continue to grow as that price goes up, and you're going to be a hero. That's going to work out great for you. But wouldn't it be greater if you could add 20 more minis to that as that price continued to go up? Listen to Tom Haugard, and he says, I cut my losers short. If it starts to go against me, if it looks like it's going to go against me, I'm out. But when that price starts to go in my favor, I'm constantly adding to my position. I'll add all the way up until the time that I'm ready to take the trade off. And then he could scale out, or he could just bulk roll out. And he's made millions and millions of dollars. So learn from people that have disciplined rules. Don't listen to people like me that say, oh, I really pulled a $700 day together, and you go, oh, I wish I could do that. Well, yeah, but the pain that I took in order to make that, and the mistakes that led up to being successful at doing that is not worth it. It's not the way to do it. So don't get yourself in a position where you get a bad trade that works out for you. Because as soon as that happens, you know that you're not a fucking trader. You're just going on luck. And you better quit trading, or you better find somebody that knows what they're doing. Because if you luck your way out of a trade and save your ass by some dumbass luck, you better be really, really, really careful. You better be really careful. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day. Follow your rules. And make sure those rules are based on fact and not fantasy.